Good day, my viewers and my professional colleagues. I'm Ayuba Kodriolayemi, Financial Reporting and Corporate Reporting Lecturer at Tryon Dynamic Professionals Training Hub, Ibadan. I'm here at this moment to make a presentation on International Financial Reporting Standard. Specifically, the second part of International Accounting Standard 23, Capitalization of Borrowing Cost. In the first presentation, we focus attention on overview of International Accounting Standard 23, the key definition, the scope. In this part, we are going to be looking at recognition, measurement, disclosure, and we will take our time to provide solution to some questions. We will take our time to provide solution to some questions. As explained in the first part of this presentation, borrowing cost is the finance cost that will be paid on borrowed fund. The normal accounting practice is to expense it. But if that borrowing cost is incurred on the fund that is obtained for the acquisition, construction, or production of a qualifying asset, such costs will have to be capitalized in accordance with the provision of International Accounting Standard 23. And this makes us to realize that the borrowing cost to be recognized as part of the cost of the assets, the borrowing cost to be capitalized as part of the cost of the asset should be that borrowing cost that is directly attributable to the acquisition, construction, or production of a qualifying asset. Lest we forget, qualifying asset is an asset that takes a substantial period of time before it is ready for its intended use or sales. Before it is ready for its intended use or sale. Now, the next issue to move to has to do with how do we measure? How do we measure borrowing costs? That is, the amount that we are going to capitalize, how are we going to determine it? Now, ladies and gentlemen, the determination of the amount that we are going to capitalize depends on whether the fund we have obtained is specifically meant for the project, or we are going to fund the project from general pool of fund. Business might have taken several loans out of which the project is going to be executed. So the measurement of borrowing cost depends on whether the fund is sourced from the general fund or we take a specific loan for the construction of the project. Now, to explain it better, let us navigate to another slide. Now, the determination of the measurement of the borrowing cost depends on whether the fund is sourced from a general pool or whether we are going to make use of the fund for the project from the general pool or a fund is borrowed specifically for the project. So, measurement. Now, assuming we have something of this nature, we are talking of specific fund. And we are talking of what? General pool of funds. First and foremost, let us consider this specific fund. When the fund that is borrowed is specifically attached to the project, that is, if the project is going to be executed from that specific fund only, the standard of the International Accounting Standard 23 is that the borrowing cost should be as follows. Should be calculated. Should be calculated as follows. Naira, we have the borrowing cost less investment income. So net borrowing cost. Now, what do we mean by this? The standard of International Accounting Standard 23 is that when money is borrowed specifically for the execution of the project, or for the, let's put it in International Accounting Standard 23 time, when money is borrowed specifically for the acquisition, construction, or production of a qualifying asset, the borrowing cost to be capitalized should be the gross borrowing cost that we are going to arrive at by applying the effective interest rate on the fund that is borrowed, less the investment income on the temporary investment of part of that fund. You see, what happens is that part of that fund can be invested if everything is not needed immediately. So whatever the interest we now earn on that temporary investment, that investment income will be deducted from the gross borrowing cost to arrive at the net borrowing cost. And this net borrowing cost is what we are now going to add to the cost of the asset. So this net borrowing cost is what we are going to capitalize. And that is the stand of International Accounting Standard 23 on when we borrow money specifically for the fund, for the project. When money is borrowed specifically for the project, the borrowing cost we are going to capitalize will be the gross borrowing cost minus what? Investment income on temporary investment. And as we have it in the slide here, it is stated that where funds are borrowed specifically, costs eligible for capitalization are the actual costs incurred less any income earned on temporary investment. Where funds are borrowed specifically, costs eligible for capitalization are the actual costs incurred less any income earned on temporary investment of such borrowing. And that is exactly what we have demonstrated there. So with this, when we have any money that is attached to the project, the borrowing cost on it is going to be what? The borrowing cost to have been capitalized less investment income that is earned on what? That temporary investment of that particular what? Borrowing, or part of that borrowing. Let us now look at the first question to demonstrate this principle. Let's look at the first question to demonstrate this principle. The first question here. An entity borrowed 5 million to fund the construction of a new building. Interest is payable on the loan at 8%. Stage payments were due throughout the construction period, and therefore excess funds were reinvested during that period. By the end of the project, investment income of 150 have been earned, and the construction took 12 months to complete. Require compute the borrowing cost to be capitalized. Now, ladies and gentlemen, this is the question. One thing we need to realize here is that this 5 million is the borrowed fund. And it is for the construction of a new building. So we assume that this new building is a qualifying asset. And we are told that interest is payable on the loan at what? 8%. So this 8% is interest rate. And by the end of the project, the investment income is what? 150. So investment income, 150,000 naira. And this investment income had been earned, and the construction took 12 months. This is a period of a whole year. We are required to compute the borrowing cost to be capitalized. Now, what we need to establish here is this. The borrowing cost to be capitalized needs to be established. And to do that, this interest rate here is the interest for a whole month, a whole year, annual interest. That is annual interest. With this annual interest of 8%, borrow fund is 5 million, which is needed for the construction. We can say that this 5 million is specifically borrowed for the construction of the building. So to know the gross interest, this 8% will be applied to 5 million. So we are now having gross borrowing cost. Gross borrowing cost. This will be 8% of 5 million naira. %8 of 5 million naira less investment income of 150,000 naira. Now, 8% of 5 million naira per annum is 400,000 naira. And investment income is 150. We are left with what? 250,000 naira. Ladies and gentlemen, that is the end of the question. We are able to calculate it this way because it's a period of 12 months. It's a period of 12 months. And it is 8% per annum. Now, that is implied in the question. So with this 25 and 250,000 naira is the amount that we are going to capitalize as part of the cost of the asset. This 250,000 naira is the amount we are going to capitalize as part of the cost of the asset. That is 8% of 5 million, which is 400,000, less investment income that is earned, which is how much? 150,000, giving us what? 250,000 naira as the net borrowing cost to be capitalized. Now let us consider the situation whereby the fund for the execution of the project is from general pool. The situation whereby the fund for the execution of the project is from the general pool. Now, if the fund is from the general pool, International Accounting Standard 23 states that we need to calculate first the capitalization rate. That capitalization rate is what we are now going to apply to that part of general pool of funds that are being used for the execution of the project. The first step is to calculate capitalization rate. That capitalization rate is what we are now going to apply to that part of general pool of funds that is used for the execution of the project. And how are we going to get capitalization rate? The guidance on International Accounting Standard 23 stipulates that that capitalization rate should be computed as weighted borrowing cost. That is weighted average borrowing cost. And to compute weighted average borrowing cost, all the sources of funds together with their interest rates will need to be considered. All the available funds together with their interest rates will need to be considered. So as I explained, where funds are part of a general pool, the eligible amount is determined by applying a capitalization rate to the expenditure on that asset. Where funds are part of a general pool, the eligible amount is determined by applying a capitalization rate to the expenditure on that asset. And the capitalization rate will be the weighted average of the borrowing costs applicable to the general pool. The weighted average of the borrowing costs applicable to the general pool. That is the capitalization rate. How we are going to get it. And when we get this capitalization rate, as I said earlier, we are going to apply that rate to that part of the pool of funds that we have used for the execution of the project. We are going to use that part of the pool of funds that we have used for the execution of the project. We can now look at an illustration on this general pool. Question number 2 is a perfect question to demonstrate this calculation of the capitalization rate when we have general pool of funds. Like we have it in this question number 2. An entity already has a number of general loan arrangements. Loan 1 of 800,000, interest paid at 9%. Loan 2 of 2 million naira, interest paid at 8%. And loan 3 of 400,000, interest paid at 7.5%. The entity has commissioned a new printing press to be constructed on its behalf. The total cost will be 800,000, and the entity will be able to fund the purchase from its existing borrowing, since it has arranged for stage payment to be made. The construction takes 6 months. The construction takes 6 months. Now, ladies and gentlemen, the key things in this question are these. Number 1, the period of the construction is what? Is 6 months. As far as this 6 months is concerned, we are coming back to it. Number 2, the total cost of construction is 800,000. We have 800,000, we have 2 million, we have 4 million. These are pool of funds. That is not what the entire amount we are going to use for the execution of the project. The total cost of the project is 800,000. So this 800,000 is going to be taken from this pool. It is not that we are going to make use of this 800,000, which has 9% interest rate, or we are going to take that 800,000 from this 2 million, or we are going to take that 400,000 from what? 800,000 from the 400,000. What we mean is that this 800,000 is going to be taken from this pool. So far, we don't know whether that 800,000 is from 800,000 up, or from 2 million, or from 400,000. So we need to calculate what? Capitalization rate. And the calculation of the capitalization rate is the first step we are going to take in this question. When we have calculated that capitalization rate, it will now be applied on what? On this 800,000, which is the amount that we have taken from the general pool of funds. Now, ladies and gentlemen, the first thing we are going to do in this question is the calculation of what? Capitalization rate. The second part of it, where we are going to calculate the carrying amount. When we explain this international accounting standard further, we will now come back to do this part of the question. Now, to calculate this capitalization rate, so computation of capitalization rate. Computation of capitalization capitalization rate. For this 9% loan, which is 800,000 naira, the interest on it has to be determined. For 8% loan of 2 million naira, the interest will be determined, and from 7.5% loan of 400,000 naira, the interest on it will be determined. The interest from these three will now be summed up. Whatever we have as the summation of this interest, all over the total summation of this fund, expressed as a percentage, that will give us the capitalization rate. The summation of the interest we are having here, all over the summation of all the what? The pool of fund. Whatever we have there, we express as a percentage. Whatever we have there will give us the what? Capitalization rate. Now, 9% of 800,000 gives us 72,000 naira. 8% of 2 million gives us 160,000 naira, while 7.5% of 400,000 gives us what? 30,000 naira. We now sum these three up. So the summation of these three is it to calculate what? Capitalization rate. We are now having 262,000, which is the summation of the interest on these three pool of these three funds that make the pool, divided by the summation of 800,000 and 2 million and 400,000, which is equal to what? 3,200,000 naira expressed as a percentage. So we have 262,000 naira divided by 3,200,000 naira expressed as a percentage. And this will give us the what? The capitalization rate of 8.2%. This gives us capitalization rate of 8.2%. And this is the what? The capitalization rate that we are going to apply to this 800,000, which is the amount we have taken from the general pool of funds for the project, that is, for the new printing press. So this is how we calculate borrowing costs when we have general fund or general pool. So the first thing is to calculate capitalization rate. Yeah, we have been able to do what? To calculate capitalization rate. So the interest on each of the loan, we calculate it, we sum them together, we now express them, the summation as a percentage of what? Of the total fund in the pool to arrive at what? At the capitalization rate. So the capitalization rate in this case is 8.2%. Now, ladies and gentlemen, the rest part of the calculation rests on whether there is a particular time that we should start the capitalization of the interest, whether there could be suspension and the cessation. Now, before we can start to be capitalizing the interest, the calculation of interest does not really base on the exact date we take that interest. And from the rest of the provision of International Accounting Standard 23, we have a particular date that we should do what? Start the capitalization of interest. Now, to capitalize interest, three conditions must be met. So, for the capitalization of interest, we must ensure that expenditure on the qualifying assets have been incurred. That is the first thing. Expenditure on qualifying assets have been incurred. Number two, we must also ensure that borrowing costs have been incurred. Number three, we must ensure that activities are in progress for the construction, acquisition, or production of that qualifying asset. So the activities must be in progress for the construction of what? Of the asset, or production of the asset, or acquisition of the asset for its intended use or sale. So when these three conditions are met, that is when we should start to be capitalizing the what? The interest. Let us say, for instance, that loan is borrowed on 1st of January, and these conditions are not met until 1st of April. That means we will start the capitalization of interest from 1st of April. And what of the interest we are now having for January, February, and March? It is not that we are not going to calculate interest, because the provider of our loan, we need to collect interest. Such loan that we don't capitalize, the implication is that such loan, we need to be expensed in the income statement. Any interest that is not capitalized in a particular period, that interest is going to be what? Expense. Are we okay? So with the example I've cited, when loan is obtained in January, but these conditions are now met in 1st of April, that means the capitalization will start in 1st of April. However, any interest we might need to calculate from January to March, those interests will be recognized in the income statement as expense. We are not going to recognize as part of the cost of the asset. Before we should start to be calculating the cost, we are going to recognize borrowing costs that we are going to recognize as part of the cost of the asset. That is when these three conditions are met. Expenditures are being incurred, borrowing costs are being incurred, and activities are in progress for the acquisition, construction, or production of the asset for its intended use or sale. Now, ladies and gentlemen, could there be any particular period when the project can be suspended? Yes. When there is interruption of active development of the project, International Accounting Standard 23 says that the capitalization of the interest should be suspended. What we mean by suspension of it is that for that particular period that there is no active development of the project, we need to suspend, we need to stop to be capitalizing the interest until we resume back when that interruption is not existing again. We need to resume back when the interruption, in the active development of the project is no more. Let us take, for instance, we have started a particular project. The good example we can cite here is this case of war, when there is war. Or let us assume that somebody has sited his factory in very close to Sambisa Forest, and there was a bomb blast, and they ran away. Definitely, if they now come back, say 6 months after, for the period that they must have run away, they have to do or stop the capitalization of interest. After the coast is now clear, that is when they will now start to be capitalizing the interest. But within the period that they have suspended the capitalization of the interest, any interest that has to be calculated that particular time, we need to be expensed in the income statement. So any interest that is not capitalized in a particular period, so far that loan has not been repaid back, the interest must be computed. However, when that interest is not going to be capitalized, it has to be what? Expense. And again, when we have a kind of interruption, which is part of the nature of the construction of the project, such interruption will not lead to the suspension of what? Of the borrowing cost. Let us take, for instance, we want to build, say, 3-story building. When we complete the first floor, we need to do a kind of decking, and we need to give it a time to dry. That drying of decking is part of the nature of the construction. We can't say that purposely because of that, we are going to do what? Suspend the capitalization of interest. Any interest we calculate because of that particular reason, we still need to be capitalized. Another example is that when we acquire a land, but before we start the construction, the land is just there. So far the land is just there, we have not started the construction of it. Any interest we calculate, we need to calculate right from the day that the land has been acquired till we start the construction on it. That interest is not going to be capitalized. Such interest is going to be what? Expense in the income statement, because the fact that we have not started the construction on it, that means activities are not yet in progress. So as a result of that, we will not capitalize the interest. Now, ladies and gentlemen, the last part of it is cessation. When should we stop to be capitalizing the interest? When all activities on the project are substantially completed, we should stop the capitalization of interest. When all activities on the project are substantially completed, we should stop the capitalization of interest. Even if the loan has not been repaid back, we have to stop the capitalization of it. So that means if the loan has not been repaid back, what we are going to do in this case is that any interest we might need to still compute after the project must have come to an end, that interest will be expensed in the income statement. Even when you obtain a loan and you use it for the acquisition, construction, or production of a qualifying asset within 8 months, and it is 3 years after that the loan is repaid, at the end of that 8 months, you will stop the capitalization of interest. For the further interest you are now going to be calculating is going to be charged in the income statement as well as expense. So any interest that we don't capitalize, so far the loan has not been repaid back, such interest we need the what? We need to be what? Expense in the income statement. Another thing is when we are having minor modification to carry out on the project. So International Accounting Standard 23 tells us that minor modification on the project does not stop us from stopping the capitalization of interest. So far, the activities for, on the project have been substantially, to complete the project have been substantially carried out. So when the activities are substantial, definitely we should ensure that we stop the capitalization of interest. But when we have major modification, that means we could see the activities as not being substantial. We should not stop the capitalization of interest. And at the same time, we have a situation whereby some projects are carried out in phases, and we can be able to determine the borrowed fund that we are making use of each particular phase. When we complete a particular phase, we should stop the capitalization of interest on it. And the condition attached to that is that when you complete that phase and you can start to be making use of that particular project, definitely we should do what? We should stop the capitalization of interest on the money that is borrowed to complete that particular phase. And when we start the construction of the next phase, definitely that is when we are going to start the capitalization of interest on the money we must have also borrowed for that second phase. Ladies and gentlemen, that is the provision of International Accounting Standard 23. Now on disclosure requirements, there are 2 disclosure requirements that are left. There are 3 before. The first one is accounting policy, but that one has been removed. And when there was a revision of International Accounting Standard 23 in year 2008. So that one has been removed, accounting policy. And at that particular time, we have benchmark treatment, we have allowed alternative treatment. Benchmark treatment is to capitalize the borrowing cost. Allowed alternative treatment is okay, we should capitalize when certain conditions are met. But that benchmark and allowed alternative treatment, which are the 2 accounting policies on borrowing cost, have been removed from that accounting standard. We are now having 2 disclosure requirements that are left there. The first disclosure requirement on International Accounting Standard 23 is the amount of borrowing costs that is capitalized during the year. That is, the question we solved the other time. So the amount of the borrowing cost there that is capitalized, the exact amount is what we are going to show. So the first question we solved, that amount is 250,000 naira. So we need to disclose that particular amount. And the capitalization rate used, the first question we solved, the capitalization rate there is what? 8%. We need to do what? Disclose such amount. So that 8% is also going to be disclosed in the question. And that is the end of this presentation of International Accounting Standard 23. However, for better understanding of this accounting standard, we will still need to take our time to solve more questions on International Accounting Standard 23. Now, the question we are going to solve now is to complete question number 2, and we solve 2 more questions so that we get better understanding of this International Accounting Standard 23. Now, to complete this question number 2, we have 800,000 naira here as the amount that has been made use for the construction of the new printing press. So this 800,000 is taken from this pool of fund of 3.2 million. We cannot say specifically whether this 800,000 is what, 9% 800,000. We can't say specifically whether that 800,000 is taken from what, this 2 million. We can't say specifically that this 800,000, they use 100,000 of 7.5%, and they take the rest 100,000 from what? From 800,000 or 2 million. So the entire 800,000 is taken from this pool of funds. So as a result of that, we have calculated our what? Capitalization rate. So the capitalization rate we have calculated the other time is what? 8%. So this capitalization rate is what we are now going to apply to what? To 800,000 naira. But by the time we are now applying that 800,000 to capitalization rate, cognizance has to be given to the period of 6 months in which that particular project is what is executed. Cognizance will be given to what 6 months in which that particular project is what executed. So now, ladies and gentlemen, the three things we are now going to make use of the calculation of this interest are: number one, this capitalization rate of 8.2%. Number two, the fund that is used for the execution of the project. A cognizance is going to be given to 6 month period that project took before it could be what? Completed. The 6 month period that the project took before it is what? Completed. It cannot solve the question. Now, ladies and gentlemen, we have loan for the execution of that project is 800,000 naira. 800,000 naira. The capitalization rate is equal to 8.2%, and the period is 6 months. So to get the interest that we are going to capitalize now, that is the borrowing cost that we are going to capitalize, the borrowing cost will now be equal to 8.2 all over 100 multiplied by 800,000 as reduced by the period it has taken to construct the project, which is 6 all over 12, which is 6 all over 12. So 8.2% is the interest rate. 8.2 over 100. The amount of loan that is taken from the general pool to finance the project is 800,000, and the period is 6 months. So we are having what? 6 all over 12. So this gives us 32,800 naira. This gives us 32,800 naira. 32,000, sorry. This gives us 32,800 naira. Now, ladies and gentlemen, this is the amount of borrowing costs we will now capitalize. This is the amount of borrowing costs we will capitalize. That is, this is the amount that we are going to add to the cost of the asset. Now, the question is now this: to calculate the carrying amount of the asset that will be recognized in the financial statement. So the carrying amount of the asset will now be equal to the cost of the asset, which is 800,000 plus borrowing costs that have to be capitalized, plus borrowing costs, plus borrowing costs. The borrowing cost, as we have calculated it here, is what? 32,800. And the summation of the two is now 832,800 naira. So this is now the carrying amount of the asset we are going to show in the financial statement. That 32,800 naira is the amount of the borrowing, the current amount of the asset we are going to show in the what? In the financial statement. Now let us solve question number 3. The third question here, on 1st of January 2007, the racecourse company took out a loan of 26 million in order to finance the renovation of a building. The renovation work started on the same date. The loan carried interest at 10%. Work on the building was substantially completed on 31st October 2007. The loan was repaid on 31st December 2007, and 180,000 investment income was earned in the period to 31st of October on those parts of the loan not yet used for the renovation. According to International Accounting Standard 23, borrowing cost, what is the total amount of borrowing cost to be capitalized, to be included in the cost of the building? What is the total amount of borrowing cost to be included in the cost of the building? Now, to solve this question, so we need to get certain facts. Number one, a loan is obtained on 1st of January, and the amount that is obtained on the 1st of January is what? 26 million naira, in order to finance the renovation of a building, on assumption that this building is what? Is a qualifying asset. That means we need to calculate the interest on it that is going to be capitalized. Now, the renovation was started on the same date. So that tells us that the date the loan is taken is the date that what? The renovation started. So far the renovation started on this particular day. Definitely the capitalization of interest is going to start on what? On this 1st of January. Capitalization of interest will start on this 1st of what? 1st of January. Now, capitalization starts. Capitalization starts on January 1st as well. Now, ladies and gentlemen, the renovation work started on the same date. So the loan carry interest rate of, so this is effective interest of the loan, so which is 10%. Work on the building was substantially completed on 31st of October. See, so this is what? 31st of October, telling us that the project was, executed over 10 months. The project was executed over what? 10 months. The loan was repaid on 31st January 2007, and 180,000 investment income was earned in the period to 31st October on those parts of the loan not yet used for what? Renovations. Now, with the way this question is framed here, you could have seen that we could have discovered that this particular loan is a specific loan that is taken for the execution of that 26 million naira project. However, before the completion of the project, that part of the loan is invested to earn investment income of what? Of 180,000 naira. The loan was repaid on 31st December 2007. Regardless of the period in which the loan was repaid, definitely the interest that is going to be capitalized is going to be based on what? On 10 months period, from 1st of January to what? 31st of October. Any interest that might accrue between November and December, we will still calculate interest for that 2 months. But the issue is that the interest for that particular 2 months is not going to be capitalized. It is going to be expensed in the what? In the income statement. Now, according to International Accounting Standard 23, borrowing cost, what is the total amount of borrowing cost to be what? To be included in the cost of the building. Now, to solve this particular question, so let us now see how the solution is going to look like. Now, the loan that is specifically obtained is 26 million naira. That is for question number 3. The capitalization rate, as far as this question is concerned, is 10%. Rate is 10%, while the construction period is 10 months. That is duration of the project. Now, to calculate this interest, there is still investment income of 180,000 naira. There is investment income that is spent on temporary investment of 180,000 naira. investment income. So investment income is 180,000 naira. Now, ladies and gentlemen, to calculate this borrowing cost, this will be 10% of 26 million naira, which is 2,600,000 naira for a whole year. However, that 2,600,000 naira for a whole year is not what is eligible for capitalization. That amount is going to be reduced by 10 all over 12 because the duration of the project is what we are going to give cognizance to as reduced by 10 all over 12. Less investment income. Whatever we are now having here is going to be our what? That's going to be our borrowing cost to be capitalized. 10% of 260 million as reduced by 10 all over 12 because the project takes 10 months to be completed. This will give us 2,166,667. While the investment income is 180,000 naira. 180,000 naira. 180K. So this 180,000 naira will be deducted from 2,600,000 naira to arrive at the amount that we are going to capitalize. So this 180,000 will be deducted from 2,166,067 to arrive at the amount that we are going to capitalize as what? The borrowing. And this gives us 1,986,667. 1,986,667. So this is what? Net borrowing cost. Net borrowing cost. Sorry. Net borrowing cost to be capitalized. So that is the end of the second question. So in this question, we are not required to calculate the what? The carrying amount of the asset. If we are required to calculate the carrying amount of the asset, that means this 1,986,667 will be added to the 26 million, which is the cost of the project. So that is the end of the third question here. So the last but not the least question. Now the solution to question number 4. The mainland commenced the construction of a new packaging plant on 1st of February 2007. The cost of 1.8 million naira was funded from existing borrowings. The construction was completed on 30th September 2007. Mainland's borrowing during 2007 comprised loan from Low Bank 800,000 at 6% per annum. Loan from Lakeside Bank 1 million naira at 6.6% per annum. And loan from Parkview Bank 3 million naira at 7% per annum. In accordance with IAS 23 borrowing costs, compute the amount of borrowing costs to be capitalized in relation to the packaging plan. Now, the requirement of this question is just the calculation of the borrowing cost to be capitalized. And when we have pool of funds, when we have general pool like this, as it is stated there that the cost of 1.8 million was funded from existing borrowings. Existing borrowings. That tells us that the existing borrowings is at what? 3, which are these what? Existing borrowings of the what? Of the company. So these are pool of fund we are talking of. So we see it as what? As general pool. Now, the first step, we have 2 steps to take here to calculate the interest. We have 2 steps to take. The first step to take here, step 1. The step 1 here is to calculate what? Step 1, we need to calculate capitalization rate. And the capitalization rate here is going to be what? Weighted average borrowing cost. Weighted average borrowing cost. That is the capitalization rate. Now to do that, it's just a matter of saying 6% of 800,000 naira. So 6% of 800,000 naira is equal to 48,000 naira. We have 6.6% of 1 million naira. 6.6% of 1 million naira. This is equal to what? 66,000 naira. While we have 7% of what? Of 3 million naira, which gives us 210,000 naira. 210,000. Now, these 3 will be summed up. So when we sum up these 3, we are having 324,000 naira. So with these 224,000 naira that we have got, the next thing is now to calculate what? Capitalization rate. So capitalization rate is now equal to 324,000 naira divided by 4,800,000 naira expressed as a percentage. Divided by 4,800,000 naira expressed as a percentage. Now, as a percentage. So, and this gives us the capitalization rate of 6.75%. So that is how we determine the capitalization rate. Now, so with this capitalization rate that we have been able to calculate, the next step, which is going to be step 2, is to apply this capitalization rate on the cost of the project. Application of this capitalization rate on the cost of the project. But by the time we are doing that, cognizance has to be given to the duration of the project. We must give cognizance to the duration of the project. We are made to realize here that the construction started on 1st of February. Construction started on 1st of February and it ends on 30th of September. So these 2 dates, 1st of February and what? 31st of what? December. We have 8 months period. So with that 8 months period that we are having there, the next thing is just to calculate what? Is to calculate borrowing costs to be capitalized. So to calculate borrowing costs to be capitalized, is a matter of just saying 6.75 all over 100 multiplied by the amount of that part of the general pool that is used for the execution of the project is what? 1,800,000. However, the project took 8 months to be completed, as reduced by 8 all over 12. And this gives us 81,000 naira. Ladies and gentlemen, 81,000 naira is the amount of interest that we are going to capitalize. 81,000 naira is the amount of borrowing cost that we are going to capitalize. And that is the head of my presentation on International Accounting Standard 23. I will appreciate your comment in the comment section of the video. and kindly subscribe to our YouTube. Thank you. Have a great moment.